Have you noticed that everyone keeps talking about silver prices while almost nobody is talking about the one story that could matter even more than the price itself? What if the biggest change in the silver market is not happening on the trading screen, but deep inside the global supply chain? What if the amount of available silver is becoming tighter while demand keeps climbing? Today, we are breaking down why the silver supply story has changed and why investors around the world are suddenly paying close attention. Silver has always been a fascinating metal because it serves two very different purposes at the same time. It is a precious metal that investors buy during uncertain times, and it is also one of the most important industrial metals in the modern economy. That unique combination makes silver unlike almost any other commodity in the world. Over the past several years, many investors focused almost entirely on the price action. They watched silver rally, they watched it pull back, they watched it move alongside gold and react to Federal Reserve decisions, inflation reports, and the strength of the US dollar. But behind all those daily price swings, another story has been developing quietly. That story is supply. For years, the global silver market has experienced a growing imbalance between the amount of silver being produced and the amount the world actually needs. When demand exceeds supply, something has to fill the gap. Sometimes inventories are reduced, sometimes recycling increases, sometimes manufacturers delay purchases, sometimes prices eventually move higher until supply and demand find a new balance. This is exactly why experienced commodity investors spend so much time studying supply trends rather than simply watching daily price charts. The numbers tell an interesting story. Global silver demand has remained remarkably strong, while mine production has struggled to keep pace. Unlike many other metals, silver is rarely mined by itself. Around 70% of global silver production comes as a byproduct of mining other metals such as copper, zinc, lead, and gold. That detail may sound small, but it changes everything. If copper companies reduce production because copper prices weaken, silver output also falls. If zinc mining slows, silver production can decline, even if silver prices remain attractive. In other words, many silver miners cannot simply decide to produce significantly more silver because silver is not their primary business. This creates one of the most unique supply challenges in the commodity market. Even when silver demand rises rapidly, supply cannot always respond quickly. Now combine that with another major trend. Industrial demand for silver continues reaching new highs. The clean energy revolution has transformed the silver market. Solar panels require significant amounts of silver because it remains one of the best electrical conductors available. Every new solar installation increases silver consumption. Governments around the world continue investing billions into renewable energy infrastructure. Private companies continue expanding manufacturing capacity. Consumers continue adopting cleaner energy technologies. Every one of those trends adds another layer of demand. Then there is the electric vehicle industry. Modern electric vehicles require much more silver than traditional gasoline-powered vehicles. Silver is used throughout advanced electrical systems, sensors, charging technology, battery management systems, and electronic controls. As global EV production grows, silver demand grows alongside it. Artificial intelligence has introduced another major source of industrial expansion. AI requires enormous data centers. Those facilities require advanced electronics communication equipment, cooling systems, and power infrastructure. Silver plays a critical role in many of those technologies because of its unmatched electrical conductivity. Few people realize that the AI revolution is indirectly supporting long-term silver demand. Then there are smartphones, computers, medical devices, aerospace equipment, military technology, telecommunications, and countless other industries that rely on silver every day. This means silver demand no longer depends only on investors buying coins and bars. Industrial consumption now represents one of the strongest long-term foundations supporting the market. While demand continues expanding, supply has become increasingly difficult to grow. Mining companies face rising production costs. Energy prices remain elevated in many parts of the world. Labor shortages continue affecting mining operations. Environmental regulations have become stricter. Permitting new mining projects often requires many years. Exploration expenses continue increasing. Ore grades at many existing mines have gradually declined. Each of these challenges makes it harder for global production to grow quickly. Building a new mine is not something that happens within a few months. It often requires a decade or even longer from discovery to commercial production. Investors sometimes assume higher prices automatically create more supply. In reality, the mining industry moves much more slowly. This delay means periods of strong demand can create lasting supply shortages before new production eventually reaches the market. Many industry analysts have therefore begun discussing the possibility of continued structural deficits within the silver market. A structural deficit simply means the world consistently consumes more silver than it produces. When that happens, inventories gradually decline over time. Those inventories cannot shrink forever. Eventually, either production must increase, demand must slow, or prices must adjust enough to restore balance. That basic economic principle has guided commodity markets throughout history. Another important reason investors are paying attention involves physical silver. During periods of financial uncertainty, many investors prefer holding physical silver bars and coins rather than paper investments. Physical demand often increases whenever inflation concerns grow, banking uncertainty rises, or geopolitical tensions intensify. Recent years have demonstrated exactly how quickly physical buying can accelerate. Coin dealers have reported periods of exceptionally strong demand. Premiums above spot prices have occasionally increased as available inventory tightened. These developments remind investors that physical markets and paper markets do not always move together. Futures prices may fluctuate every second, while physical supply conditions develop over much longer periods. Central banks have also changed the broader precious metals landscape. Although central banks primarily purchase gold rather than silver, their continued accumulation demonstrates growing interest in tangible reserve assets instead of financial assets alone. That shift has encouraged many private investors to reconsider their own precious metals allocations. Gold often receives most of the attention. Silver frequently follows once investor confidence expands. Market psychology also plays a powerful role. When financial markets remain calm, investors often prioritize growth assets. When uncertainty increases, many begin searching for diversification. Silver benefits from both investment demand and industrial demand, making it one of the most interesting markets to watch during periods of economic transition. Another factor deserves attention. The Federal Reserve continues influencing nearly every major financial market. Interest rate decisions affect borrowing costs, business investment, consumer spending, housing activity, and currency values. Higher interest rates generally strengthen the U.S. dollar, while increasing the opportunity cost of holding precious metals. Lower interest rates often create a more supportive environment for gold and silver. Because markets constantly adjust expectations long before actual policy changes, investors carefully monitor every speech, every inflation report, and every employment release. Those expectations frequently create significant volatility in precious metals even before the Federal Reserve announces any decision. That brings us to another important point. Silver is no longer simply reacting to one factor. It now sits at the intersection of monetary policy, industrial expansion, global manufacturing, renewable energy, technological innovation, inflation, expectations, and long-term investment demand. That combination explains why so many analysts believe the silver story has fundamentally changed, and this may only be the beginning. The most interesting part of the silver market today is that many investors are still looking at yesterday's story instead of tomorrow's opportunity. They continue asking whether silver will follow gold while ignoring the possibility that silver may eventually begin creating its own independent momentum. History has shown that silver often remains quiet for long periods before making surprisingly powerful moves. During previous precious metals, bull market silver frequently outperformed gold once investor confidence returned. That does not mean history will repeat exactly, but it reminds us that silver has always been capable of moving much faster than many expect. One reason is simple. The silver market is much smaller than the gold market. Because the market is smaller, even modest increases in investment demand can have a much larger impact on prices. When institutional investors, hedge funds, pension funds, and private investors begin increasing their silver exposure, the available supply can tighten surprisingly quickly. This is one reason experienced commodity traders closely monitor exchange inventories. When inventories decline while industrial demand remains strong, investors begin asking an important question. Where will additional supply come from? That question has become much more difficult to answer. Several major mining regions continue facing operational challenges. Higher operating costs remain a concern. Energy prices continue affecting production expenses. Political uncertainty has increased in several mining jurisdictions. Environmental regulations continue becoming stricter. New discoveries have become less frequent. Meanwhile, existing mines continue producing lower-grade ore than they did years ago. Every one of these developments affects future production. Mining companies cannot simply increase output because prices rise for a few weeks. Large mining projects require billions of dollars in investment. They require years of environmental studies. Infrastructure must be built. Financing must be secured. Governments must approve permits. Workers must be hired. Equipment must be purchased. Production often begins many years after the initial discovery. This slow response creates an important advantage for long-term investors. Demand can increase much faster than supply. That imbalance is exactly what many analysts believe is beginning to develop once again. Another trend receiving increasing attention is silver recycling. Higher prices usually encourage more recycling activity. Old jewelry, industrial waste, electronic components, and photographic materials all provide additional sources of silver. However, recycling alone has not been enough to eliminate recent supply deficits. Industrial demand continues expanding faster than recycled supply in many areas. That means mining remains essential for balancing the market. Now consider what happens if economic conditions begin changing. If inflation continues slowing, the Federal Reserve could eventually have room to reduce interest rates. Markets often begin pricing that possibility long before the first rate cut actually occurs. Lower interest rates can reduce support for the US dollar. A weaker dollar often benefits commodity prices because buyers using other currencies gain greater purchasing power. Gold frequently responds first. Silver often follows with even greater percentage moves once investment demand accelerates. Treasury yields also deserve attention. When bond yields rise, investors can earn stronger returns from fixed income investments. That sometimes reduces interest in precious metals. When yields begin falling, the opposite can happen. Gold and silver often become more attractive as investors seek alternative stores of value. Every inflation report therefore becomes extremely important. Every employment report influences interest rate expectations. Every GDP release shapes market sentiment. Every Federal Reserve statement receives immediate attention from traders around the world. Markets are constantly looking ahead. Prices usually move before economic conditions become obvious. That is why professional investors spend so much time studying expectations rather than simply reacting to headlines. Another major factor involves global central banks. Although they primarily accumulate gold, their actions demonstrate growing concern about long-term financial stability. Many countries continue reducing dependence on traditional reserve currencies while increasing holdings of tangible assets. This broader shift has strengthened confidence throughout the precious metals sector. Private investors often notice these trends and gradually increase their own exposure. Silver benefits from that growing interest. Geopolitical uncertainty also continues supporting precious metals. Trade disputes, military conflicts, energy security concerns, and changing international alliances all create uncertainty within financial markets. Whenever uncertainty rises, investors frequently search for assets with long histories of preserving value. Gold has traditionally received most of that attention. Silver often attracts additional investment once confidence in precious metals expands more broadly. Technology may become one of the strongest long-term drivers of silver demand. Artificial intelligence continues expanding at an extraordinary pace. Every new generation of advanced processors requires increasingly sophisticated manufacturing. Modern semiconductor production depends upon highly specialized materials, including silver. Cloud computing continues growing. Telecommunications networks continue expanding. Data centers continue multiplying. Renewable energy investment continues accelerating. Electric vehicle production continues increasing. These are not short-term trends. They represent structural changes within the global economy. Each one increases long-term demand for silver. At the same time, supply growth remains limited. This combination explains why so many analysts believe the silver market deserves far more attention than it currently receives. Of course, no investment moves in a straight line. Silver will continue experiencing periods of volatility, Sharp rallies may be followed by sudden pullbacks. Unexpected economic data can temporarily change investor sentiment. Federal Reserve policy may create short-term uncertainty. Currency markets may fluctuate. Profit-taking will always occur after strong advances. These temporary movements are normal. Long-term investors often focus more on the broader trend than on daily price changes. The most successful investors understand that volatility and opportunity often appear together. That mindset becomes especially valuable in smaller markets like silver, where short-term price swings can be dramatic while long-term fundamentals remain unchanged. The market is beginning to recognize that the supply story has evolved. Demand continues growing from multiple directions. Production faces increasing challenges. Inventories remain an important area to watch. Monetary policy could become more supportive over time. Industrial consumption continues reaching new records. All these factors together are creating one of the most closely watched silver markets in many years. In the final part, we will connect all these developments and explain why many investors believe the next chapter for silver could be very different from the one the market has experienced over the past few years. As we reach the end of this discussion, one message stands out above everything else. The silver market is no longer being shaped by just one factor. It is being influenced by a combination of growing industrial demand, limited supply-changing monetary policy, and rising investor interest. When several powerful forces begin moving in the same direction, markets can eventually experience changes that very few people expected at the beginning. Many investors continue focusing only on daily price movements. They check the market every morning, they celebrate small rallies, they worry about every correction. But experienced investors understand that the biggest opportunities usually develop quietly, long before prices fully reflect the underlying fundamentals. That may be exactly what is happening with silver today. The world is changing faster than ever before. Artificial intelligence continues expanding into every major industry. Renewable energy investment continues reaching record levels. Electric vehicle production keeps growing. Modern electronics continue becoming more advanced. Medical technology continues improving. Telecommunications infrastructure continues expanding. Every one of these industries depends on silver in one way or another. Unlike many other commodities, silver is not easily replaced. Its unique electrical conductivity, thermal conductivity, and durability make it extremely difficult to substitute in many high-performance applications. That gives silver an important long-term advantage. Demand can continue increasing even during periods when prices rise because manufacturers often have very few practical alternatives. Now compare that growing demand with the supply side of the equation. Mining companies continue facing higher operating costs. Permitting new projects remains slow. Environmental regulations continue becoming more demanding. Ore quality continues declining at many mature mines. Most silver production still comes as a byproduct of other mining operations. That means silver supply often depends on the health of completely different commodity markets. Even if silver prices move sharply higher, production cannot immediately respond. This creates one of the strongest long-term arguments supporting the market. Another reason investors are paying close attention involves inventories. Every year that the market consumes more silver than it produces, available inventories become smaller. Those inventories provide an important buffer during supply shortages. However, no inventory lasts forever. If structural deficits continue over several years, eventually, the market must find a new balance. Historically, that balance has often arrived through higher prices, encouraging additional investment and eventually increasing production. No one knows exactly when that adjustment may occur, but markets have always followed the basic laws of supply and demand. That has never changed. The Federal Reserve will continue influencing precious metals throughout this process. Future inflation reports, employment numbers, consumer spending, manufacturing activity, and GDP growth will all shape expectations for interest rates. If inflation gradually moves lower while economic growth slows, the Federal Reserve could eventually adopt a more supportive monetary policy. Markets often anticipate those changes well before official decisions are announced. A weaker U.S. dollar combined with lower Treasury yields has historically created a favorable environment for both gold and silver. That possibility remains one of the most closely watched themes among professional investors. At the same time, geopolitical uncertainty continues, adding another layer of support. Global trade tensions, regional conflicts, supply chain disruptions, and energy security concerns continue creating uncertainty throughout financial markets. Whenever uncertainty increases, investors often seek assets that have demonstrated resilience across generations. Gold has traditionally served that role. Silver often benefits as investor participation expands across the precious metals sector. Another important trend involves institutional investors. Large investment firms continue studying precious metals as part of broader portfolio diversification strategies. Even a relatively small increase in institutional allocation can create meaningful demand because the physical silver market remains much smaller than many other financial markets. That smaller size can produce larger price movements once buying momentum begins building. Retail investors have also become more informed. Access to financial information has never been easier. People now follow mining production reports, central bank activity inflation data, Federal Reserve statements, industrial demand statistics, and global economic developments more closely than ever before. As awareness grows, more investors begin recognizing that silver represents far more than simply another commodity. It is both an industrial necessity and a financial asset. Very few investments offer exposure to both economic expansion and financial uncertainty at the same time. Silver does. Of course, every investment carries risk. Unexpected economic strength could support higher interest rates for longer. A stronger dollar could temporarily pressure precious metals. Industrial demand could fluctuate if global manufacturing slows. Market sentiment can change quickly. Short-term volatility should always be expected. That is why successful investing depends on preparation instead of prediction. Understanding the long-term drivers behind an investment often proves more valuable than trying to predict every daily price movement. The current silver story is no longer only about today's price. It is about tomorrow's supply. It is about growing industrial demand. It is about renewable energy. It is about artificial intelligence. It is about electric vehicles. It is about monetary policy. It is about inflation. It is about global diversification. It is about a market that may be entering a very different phase than the one investors have become accustomed to over the past decade. Whether silver moves gradually or experiences another powerful rally, the underlying story deserves attention. The combination of expanding demand, constrained supply, evolving Federal Reserve policy, and continued global uncertainty creates one of the most compelling long-term discussions in the entire commodity market. This is why more analysts, more institutional investors, and more private investors are beginning to study silver more carefully than they have in years. The next major move may not happen overnight. Markets rarely move according to a schedule, but history has repeatedly shown that when supply becomes tighter while demand continues growing, the market eventually responds. The only question is when. That is why staying informed remains one of the greatest advantages any investor can have. If you enjoyed this deep analysis, make sure to like this video, subscribe to Silver and Gold Watch, and turn on notifications so you never miss our latest updates on gold, silver, inflation, the Federal Reserve, the US dollar, and the global economy. Thank you for watching, and now we would love to hear from you. Do you believe the changing silver supply story could lead to significantly higher prices over the coming years, or do you think the market is still underestimating the risks? Share your thoughts in the comments below, and we will see you in the next video.